Yeah, we've talked a lot already about currency, but Jay, can you explain how the pound retaining it, the UK retaining the pound, how that has helped in this particular scenario so far?
Right. So even if the UK doesn't go into recession, I mean, clearly it seems like economic activity there is going to weaken, and by continuing to have the pound at a lower rate, so on trade-adjusted terms, it's depreciated somewhere around 10, maybe 15%. And so what that does is that improves the price competitiveness of UK exports. And so, if you view the UK and compare it to, say, vis-a-vis Greece, Greece is in a depression right now. But because they can't adjust their exchange rate, they have to grind through this whole thing. And so this, I think the term was used earlier, a shock absorber. Sterling does act as a shock absorber here. It does puts in play ability for the UK economy to recover from this as their exports become cheaper. And so it's, obviously in retrospect, it was a good thing during the crisis. It's even a better thing now that the UK still has its own currency, can help it adjust.
Yep. Can I just add that it actually goes further than just sterling as a shock absorber. It actually is that Britain still has more control over monetary policy as well as fiscal policy. So as you've seen, the Bank of England the week before last lowered interest rates to only 0.25% and issued another round of quantitative easing, both for corporate bonds and for government bonds, which a country that's in the Eurozone wouldn't be able to do that. And you will also no doubt see the government reacting in terms of fiscal policy in due course during the fall period, probably at the autumn statement. And they've already said that they will be delaying the fiscal consolidation process.
Yeah, and I heard two things from you, John, there. Importing inflation, and then also the UK could become quite a good hub for manufacturing. Mm-hmm. We'll leave the inflation to Jay, but just where are you with the UK becoming quite
well, I think it's a current, I think you've got to think about two things. How long will that currency remain as competitive as it is? And that's a very tough bet when you're putting assets in. I mean, in our case, we're a consumer products business, so they're fairly light assets. But if you're a major manufacturer putting heavy assets in, you're sitting there thinking, okay, this is a 40-year, 50-year investment. It's inconceivable the pound will be, I think anyway, as cheap as it is today because obviously if this actually is a fairly benign impact for the UK, the one thing that's going to happen is the pound will actually improve. So that's sort of the irony of this. I think the other thing you're thinking very carefully about is, well, what will be the negotiation between the UK and the EU in terms of trade? Now, obviously, a lot of these countries, if they're pragmatic, have massive export to the UK, and they'll be thinking, well, they might be very careful. However, if emotion gets in the way, they might be less than careful. So I think if you think of all that together, as I said, I think you're planning, but you're certainly not acting. So you're really sort of thinking about contingency planning, and then when you feel you have some certainty, you may move.
Gotcha.
In the very short term, however, you're saying I need to improve the margin on what I'm selling into the UK, and one way of doing that is actually to go in and ask for price increase, which I think you'll see a number of people doing, hence the imported inflation.